To in-crop or not to in-crop? That is the question. There's a say, if you own a business, you can beat the tax system. You make the tax rule and pay much less tax compared to an employee. Is this a myth or a fact? In today's video, we'll explore the benefits of having a corporation, which type of the corporation fits you, and what kind of tax advantage that you have. Hey everyone, it's Thomas here. Better mindset, better life. We'll continue going over the book 15 Secrets That Taxman Doesn't Want You to Know. If this is your first time here, this channel is to learn how money works and how you want to work with money in Canada. If you have any questions related to your finance, feel free to reach out in the comment section below. Your support will be my biggest motivation. Let's jump into it. Setting up a company is not as complicated as you think. You don't need a physical building to call yourself a business owner. A withholding company is merely some paperwork and a name attached to it. And the name can be like ABC123. A bunch of numbers with no meaning is okay too. You can register the company yourself, although I recommend to let your accountant or lawyers to deal with it. There are only two benefits for having a corporation, for liability and tax purpose. Normally, for employees, the flow of income goes like this. First, money earned, then money get taxed, and you spend the rest of the money to food, gas, daily expenses. On the other hand, if you are quote-unquote a business owner, then the pattern will be like this. Money earned, but you spend it first, then the leftover gets taxed. Through a corporation, you can spend the earning before the government gets their hands on it. So you see why all the high-income earners like lawyers, dentists, car mechanics always have a corporation. If your business deals with more than one customer, once your income reaches to a certain level, it's time to consider to incorporate or not. There are two ways to set up business structure in Canada. First type is the unlimited liability company, such as sole proprietorship, which is owned by one person, or partnership, which is owned by two or more people. Either way, the business involves you and your partner only. All expense and income are factored into your income tax. You're responsible for all the debts and obligations of the business, which also means that in the event things did not go well, any claims could go into your personal assets. John runs a construction company in a sole proprietorship. One day, if he gets sued because a project that he built failed, not only he may lose his company and possibly everything in his assets, including his house. Partnership is similar. If Tom and Mary decide to open a restaurant together, if something happens to one side, it affects to all partners and possibly to their personal assets. It's quite scary when there's no limit on the liability. Sole proprietorship or partnership have simple business structure. It has a lower startup cost. It costs less than $200 registered to the government. The income expense attached to personal income, so if your business is losing money, you can reduce your total personal income. But as the company grows, it's better to move it to the second type, which is the corporation. Because one, now the liability goes to the company only. Two, you have a more tax advantage. And three, it's easier to move assets tax efficiently if they have increased in value in the long run. The second type is the limited company. Example would be like ABC Ltd, 123 Corp, or Inc. The ending name doesn't make a big difference, but they are all under the same category. Compared to sole proprietorship or partnership, the cost to set up limited company is higher. It involves bookkeeping, payroll, GST account, CPP and EI, etc. And CRA will monitor much tighter as well. On the contrast, the Canadian government gives a huge support to small business owners. For this video, I will only talk about the CCPC, the Canadian Controlled Private Corporation, where pretty much 90% of the small business are under CCPC. First, for any amount less than $500,000 business active income, the corporate tax is between 11 to 15%, depends on which province your business is at, compared to 50% personal tax rates if you make $500,000 alone, and that is a huge gain already. Next, as the company owner, you have more control in paying the shareholder, which is usually yourself again, usually in the form of income and dividend. Since dividend has another tax advantage, so overall the shareholder saves quite a bit from the two taxes. But keep in mind, Dividend is not considered an active income, so it does not contribute to your personal RRSP rule. Also, it might hurt your personal borrowing power when it comes to mortgage. The other advantage CCPC has is after years of growing the business, one day if you decide to retire, you can dissolve or sell your practice to others. There's a lifetime of 886,000 tax-exempt quota. Let's say John's business starts at zero and grows to $1 million when he sells it. The growth is $1 million minus the 886,000, which is 114,000. 15% of that will be taxed, which is 57,000 to the CRA. Imagine if you sell an investment property and the $1 million is the capital gain. 50%, the $500,000 will be capital gain tax, so 250,000 goes to the CRA. A big difference in here. But of course, CRA is always the smartest person in the room. They let CCPC to have a huge tax advantage under the small business deduction. But now, CRA targets and taxes very heavily on the corporate-owned investment. For example, Tom is a construction consultant and he has a Tom123.inc. Since most of the expense can be paid by the company, Tom managed to save $1 million under the business account. He does not want the money to lose to inflation, so he decides to invest the company's money to stocks, rental property, and leave some in the term deposit. Sound pretty reasonable, right? And here's the fun part. Under the CCPC tax rule, for every dollar you earned on the interest, 51% goes to the CRA. So for John, if he gets 5% return from the company's investment, he needs to give $25,000 as tax. And that's not it. If the passive income is more than $50,000 per year, the $500,000 small business deduction rule will start to shrink, meaning instead of 11% small business tax rate now goes to 27%. Again, the house always wins. Many small business owners are very involved into their day-to-day practice, and that they fail to take time to keep track of the tax implication and plan for the long term. They all feel that their accountants will keep them advised, but in most cases, they only report and do what they are told. Now, a lot of accountants give advice on how to receive a maximum tax advantage or what changes can be made to lower taxes. Keep in mind, there's no tax-free saving for the corporation, but there are ways to create tax shelter accounts for small business. And besides income and dividend, there are more ways to take it from the corporation tax efficiently. And that is another topic for next time. I will put all the useful links down below in the subscription box. If you're a small business owner, do you pay yourself in salary or in dividend? Tell me more in the comment below. This is Thomas. If you want to learn how money works and how you want to work with money, then I will see you in the next video.